As we round out the year for 2025, let's look back and see what lessons we've learned and perhaps some good ideas as we think about the year ahead. Join us for the next episode.
Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome back to the show, Something More with Chris Boyd. As we wind down the year, we wanted to take a moment to look back and see what worked and maybe some lessons from things that didn't. And joining me to discuss these things, I've got Brian Regan and Jeff Perry. Both all three of us are from the AMR team at Wealth Enhancement, and glad to have you joining us. If you don't listen to the show regularly, a couple of things to remember. You can find us on YouTube. You can find us on Spotify or Apple Podcast or just about anywhere you might listen to a podcast. And of course, you can always go to our website, Something More with Chris Boyd. We'll get you there. .com. We'll get you there. It's wealthenhancement.com/AMR, and that'll bring you to our team. All right. With that, let's get started. Where should we begin? Jeff, I'm going to turn it to you for a minute. Anything you want to start with or think back about?
I can't believe the year is just about over.
I know.
This one, they say the older you get, the quicker the years go. But this year really flew by, and so I'm interested in this conversation. It's generally good year for investors, so that's good.
A little perspective about, I think we sometimes forget about pain points. We did have some big disruption, almost a 20% decline in, what was it, March, maybe somewhere there.
The date was known as Liberation Day.
Once Liberation Day hit, or actually even going into that, there was some decline.
Tariff fears
about tariffs and the initial thoughts of a pretty extreme change in policy. Brian, I know we had many conversations about what does this mean and how might it impact not just markets, but the overall economic impact of this. Fortunately, things didn't really turn out to realize some of the fears we had, as rhetoric initially sounded like it was going to be a real severe and extreme change in policy. It seems like it's moved incrementally, a little bit more than we might have seen in past times, but not so severe that it's created severe economic disruption.
This is also an example of companies improvising, adapting.
They learn to adapt.
They do different things, obviously the purpose of tariffs is to get people to reshore in the United States manufacturing, right? That's the stated goal. And
or revenue for the for the government, right?
I think the president has spent this trillions of dollars about 4 times. But my point is, companies, not to get political here, companies find ways to either absorb some of it, pass it along. Retailers do the same. So it's an example of when American business knows what the rules are. They don't like it when rules change, right? But when they know what the rules are, tax-wise, tariffs, policy, they can adapt, they can improvise, and they can overcome the challenges, to a certain level anyway.
That's a good point. Brian, you want to comment on any of the whole, maybe start off with tariffs, but where do you want to jump in?
Yeah, I think it's interesting to talk about what we did in our portfolios and why, and tariffs are a conversation. And I do every morning, and maybe I shouldn't do this every morning, but I do an attribution of our 50-50 to see, what's working, what's not, what's contributing to the portfolio, what's detracting from the portfolio. And I try to keep that ongoing analysis Because it just keeps me very, very plugged into every single asset that we have in the ETF and mutual fund portfolio, whether it be fixed income or equity.
The 50-50 he's referring to is an allocation of half stock, half bond, roughly, or a modest, we'll call it a conservative investment strategy. But that gives a kind of an overview of the range of investments clients may have across a variety of strategies, right?
Right. I think it's the one that makes the most sense to look at. So as you can imagine, if we do really, really well in our equity, the more aggressive strategies are probably going to do really, really well. If we do really, really well in our fixed income, well, the lower risk strategies are probably going to do really well. And this is an interesting year. For a reminder, I manage two different kinds of strategies. One's ETFs and mutual funds, and one is individual stocks, composed of about 30 different stocks. I think these comments, I'm going to concentrate, I think, mostly on the ETF and mutual funds, but I have some comments for the individual stocks as well. So, overall, I think we had an exceptional year. We came into the year with the idea of taking less risk, whether it be because we thought the markets were expensive or we thought tariffs were on the table, a new administration. The possibility of inflation being higher if those policies were enacted, especially since it was a fully controlled government. We came into the year taking less risk, and that was the case. We were underweight risk basically throughout the whole year until November. And in a year that was so far, through December 18th here, a very, very good year, with the S&P 500 plus almost 16% as of today, and the All Country World Index, 19+%. A good year. So if you were underweight stock, that was obviously a detractor. If you were underweight emerging markets, that was a detractor. So we were underweight emerging markets because generally we're not too interested in being having a lot of China exposure for a variety of reasons we can get into. So, we were kind of behind the eight ball as it was based on those two stances and what performed really, really well in the equity markets throughout 26. So we had to be more aggressive in other places, and we were more aggressive in our sector selection, more than we have in any year that I've worked with Chris and the AMR team. And that made up a huge part of the difference. So, following Liberation Day, we maintained an underweight risk tolerance, but we added more high yield as the credit market sold off. We added a semiconductor-specific ETF. We added aerospace and defense, as we thought this would create more geopolitical uncertainty and give tailwinds there. And we've had an ongoing utility sector selection, which is significant. Utilities are a small part of any benchmark, and it's a pretty big part of our portfolio. So, we have a big. You could look at it as a big overweight to utilities, which has been one of the better performing sectors over the last couple of years. Semiconductors have screamed higher since Liberation Day. Our added growth tilt also did very well. And aerospace and defense, which we only held for one quarter, did 30+% in that quarter. So we made up plus some against the S&P 500. All of our underweight plus a good margin by doing some very smart sector selection throughout the year. Against the All Country World Index, which was harder because of the lack of emerging market exposure, and the general underweight in international, which did better, has been harder to catch. So, how did we make up for that underweight in international? Well, yes, through sector selection, but we also had to be more aggressive through our alternative selection. We got very aggressive in the buffered ETFs from the innovator funds this year, and those don't perform as well as the indexes, but they highly correlate with the indexes, and they have a buffer on the downside. So you are taking less risk and you're getting less return. But we're controlling our risk there. We got better than bond-like returns, kind of in a bond-like space, and I think that was a big win. Later in the year, starting in November, we added regional banks because we expected the yield curve to steepen. The yield curve has steepened. Regional banks have performed very well. And we also added gold for similar reasons. And gold has done well since we added that. So we made up a big difference from the alternative space this year. So despite being underweight stock 11 out of the 12 months this year, or 10 out of the 12 months this year, I think we were able to make up for it in other areas of the portfolio. Finally, fixed income, we didn't make any mistakes. And that's all you can ask for in the fixed income space. We, across the board, our fixed income selections in the ETF mutual fund strategies are positive. Fixed income generally had a very good year. But certain parts of the what you could call the fixed income market, like private credit, certainly made headlines. There's a story out today about a real estate fund that was actually pitched to me 2 years ago in New York that had so many redemptions that they had to make it a closed fund. And when they made it a closed fund and they actually had to mark their assets appropriately, they had the net asset value dropped 40%. So there were a lot of possible pitfalls, and we didn't step in any of them. So
Brian, can I ask you a little bit about private credit? Because that's been a story of this past year, where now more individual investors and retirement investors have access to some of these private markets. How do you view that as an opportunity to get into a space that historically wasn't available, or do you see more danger signs than it's worth?
I think it's a terrible idea.
Yeah.
Sometimes I'm in a mood not to mince words, and
sometimes tell me what you really mean. Yeah.
Sometimes. That's what we love about you, Brian.
And I think this is a big push.
It's nonsense. Baloney sauce.
I was waiting for that, Chris. I saw you reaching for it.
Let's talk about what's going on in private equity, right? I think this is more of a private equity conversation than a private credit conversation.
Okay.
So buyout funds and venture capital funds have had a lot of trouble. And if you look at the vintages for private equity and private and venture funds for the 6 to 9 years. So these are funds that have lasted for 6 to 9 years. They are not monetizing their assets. So what does this really mean? It means they have a bunch of assets that they overpaid for. Okay. They say a lot of fun words and all this, but they're sitting on a bunch of stuff that nobody else wants to buy at the price they want to sell it at. And they, for one reason or another, they can't do an IPO, probably because the company's no good. Mm-hmm. So there's a ton of assets sitting in venture capital and private equity that are seasoned. And the only way that they can continue to operate or make any distributions is if they bring in more money. So what have they done? They've gone to the wealth management channel over the last few years. Chris and I, and maybe you, Jeff, know that this has been overwhelmingly pitched in every corner of the world for years now. Why? They need to plug this monetization hole. They need to be able to fill redemptions from other clients. They need to be able to start their new fund from when they don't have any clients that are already sitting in the existing funds that haven't been monetized. Yep. This is just another version of that. They're looking for another source of funds. And if they cannot get another source of funds, it will unravel. And so this is just it's a way to keep the scheme going. If you don't have good assets and you overpaid for them, you don't fix that problem by going out and collecting more cash from unsuspecting people. And that is what I think this is all about. And that's why it makes me sick. And I do think it's baloney sauce.
You spell it out pretty plainly and candidly. I think you do people a favor by doing that. And it does bring you back to a different era. 15 or whatever years ago it was, when we were maybe 20 years ago, when we were seeing all these loans being bundled up and subprime and all the rest of it, right. And unsuspecting people buying investments that were
Package for
problems
investors.
waiting to happen. Let's put it that way.
So Michael Semblis puts out this every 2 years. He puts out this great piece. Michael Semblis is I think he's a chief market strategist or maybe the chief investment officer of JP Morgan. He puts out this great piece every 2 years on the alternative markets. And I encourage everybody to read it. It's interesting. It's a good read. He does the good research. And he's honest and ethical, which I can't say about everybody in this industry. And he evaluates private credit. And one of the things he says is, you're getting 3% historically over the last, I don't know how many years he looked back. You're getting 3% over a syndicated leveraged loan, which is good, right? You're taking more risk. You have less liquidity, you have higher fees, you better get a higher return. Now he goes to great pains to say, okay, this is there's been growth in the economy. That's what you should expect, aside from 2022, but in 2020. But his argument was they were too short to really have any big impacts. My argument would be, and he does great work, but I couldn't help but to think the managers that are getting paid 1 in 20 or 2 in 20 on these products have every motivation in the world to keep their marks as high as possible. And if your marks are excessively high, as we know they were, at least in that Bluestone situation, and the article on the Financial Times on that today can spell it out more clearly than I could state on this podcast. They're way too high in a lot of cases, right? If you're carrying something at par, at a dollar for dollar, and it's worth 60 cents on the dollar, you did not have an 8% return. Okay, right. You need to discount that by the price of the asset today, and I just don't believe any of these things, and partly because of you can see that some of the BDCs have been priced. There's this great chart, this guy in the fundamental research group that Chris DeCarolis shared with me about the same loan held by 5 different publicly traded BDC companies and their different marks. And they were within 30 points of each other, not 30 basis points, 30 percentage points. Some had them marked at 70, some had them marked at 100. What's the value of that asset? Nobody knows. And the lack of transparency, I have a real concern when I think a lot of people, from experience, I've seen this in people's portfolios. When they look at their 401k, they look for the things that have the best historical returns. Uh-huh. And it's reasonable to do that, right? You want to get your money into the best performing funds. But what if those performance numbers are just bunk, right? Because the manager is going to get paid more if the marks are high, and he's going to get paid less if the marks get brought down, and so he's in control of the marks.
Conflict of interest, in effect, you're saying, yeah.
Right. So, forgive me if I'm ranting
and marks
here, but
for
this
clients, for listeners, this is essentially saying what's the value of that investment is what Brian's talking about.
Since it's not publicly traded, nobody actually knows what another person's willing to pay for it, right? So you can make it up, right? You essentially make it up.
And the gentleman you referenced is another wealth enhancement analyst or portfolio manager.
Yeah, Chris, he's another senior portfolio manager at Wealth Enhancement.
Just wanted to give.
He's the head of the fundamental research group.
Nice.
So for listeners, Brian does not prefer private credit or private equity in our portfolios.
Well, me and Chris DeCarolis, we have a passion for staying away from the Baloney sauce, if you will. So
potential
we both like to
for
share
our clients is really what it is. You're trying to watch out for your clients.
Well, so this is what'll happen, right?
Step one is don't make a big mistake, right?
Right.
So this is what'll happen, right? The music is kept going because of maybe the wealth management channel. The music will keep going if they get in the 401k plans. And everybody will say, look, this was a great idea. Why have we been keeping people out of this? And then the music will stop. And then there will be lawsuits. And that will be the end of this. Now, do you want to be a plaintiff in that lawsuit, or do you want to keep your money?
Yeah.
I mean, I rather keep my money, right? So
especially where there's other alternatives that have the clarity, the greater transparency of pricing and the liquidity and
Right.
all kinds of other
All kind of
benefits.
regulations.
Yeah, you'd just rather be involved with rather than have the sizzle, the appeal of like what's the latest greatest, but it may not actually be so great as time passes. We'll see. But fair enough.
yeah, I mean, I
I don't think Brian's waiting to see. I think he knows.
Yeah, he knows. Let's also.
I don't personally own any private credit or private equity, and I don't really see the need to. I don't know why I need to own a canned water company that's held in the private markets, or a chip company that's getting a new bag because a private equity company bought it, when I can buy Google, Alphabet, which is a diversified company with a money-making machine that's been going on for 30 years, and the moat is wider than the Grand Canyon.
This brings me to
you'll never get me to
ask, and that's I think we keep hearing about concerns people have about an AI bubble. This notion that can this continue? It's been going so great with particularly some of those names that are these top tier names in the index. They're buying into this AI evolution and how it will impact our economy in various ways, and the amount of infrastructure spending that's going on. Is this a concern to you? I know the answer, but for our listeners, as we approach year end, AI has been a driver of part of why the markets have done so well. Is this poised for a fall?
It's a concern, sure. But what do you do about it, right? I mean, it's one thing that there's a lot of talking heads, and there's very few people that actually have to manage money and make decisions. And when you're on our side of the table and you have to actually make decisions rather than just talk about it, I got to ask myself, what is it actionable? What do you do? If you've been worried about an AI bubble for the last 12 months, what do you tell your clients? Sorry, you made 4% this year because I was afraid to take any risk. That's the wrong conversation. The right conversation is that what Chris and Jeff do every day is you get to know the people and you start to understand how much risk they can take, and you execute on that plan, right? You don't just shy away from everything for one reason or another. These are the best companies in the world right now. They're making money. There's no doubt about it. Their growth is fantastic. This isn't necessarily Pets.com. Pets.com didn't have any revenue. It was an idea. It was a website. It was a URL that went public, right? It might be Cisco, right? Cisco was a hardware company that still exists today. That is arguably a wonderful company that's stood the test of time, but it took 25 years to get back to its all-time high, and I'm not making that number up. 25 years. I think it just recently did it. So I don't want to be stuck for 2.5 decades with overvalued stocks. So I do believe there's some overvalued stocks, and I try to avoid them, and we try to be diversified. I mentioned earlier that we have a significant overweight in utilities. Utilities are let's call 1% of the S&P 500. We have significantly more than that, and that to me is a natural ballast to the semiconductor stocks. You could argue that it's all part of the same trade, sure, but it's kind of hard to make that leap from a regulated utility company to something that sells hardware. At the same time, I do think, and the fundamental research group actually disagrees with me on this one. I'm kind of surprised. But I do think that if there is a pullback in capital spending by the hyperscalers, the consensus expectation is it's going to bring down the whole market. I don't necessarily think that's true. I think it's going to bring down hardware companies. It's going to have an impact on NVIDIA. It's going to have an impact on AMD. It's going to have an impact on Dell and Supermicro. But when you pull back on capital spending, your earnings actually rise. So what would you expect if earnings were to rise? If your R&D costs go up, you ought to expect the stocks to do well, right? So if Meta, Microsoft, Oracle, Amazon, Alphabet, if they were to cut back on their spending, their earnings go up. Do you think their stocks are going to go down? they could. I mean, they could all go down in sympathy together as the quote unquote AI trade. But that's not something to be discouraged about. That's something to be encouraged about because you have the opportunity to buy them.
Well, that is the balance question that's out there. I mean, there are people who are suggesting that these companies are spending too much on R&D. And, to your point, if they scaled that back, some investors would look at as a positive.
Completely agree. I mean, I think it would absolutely be a negative for the likes of NVIDIA. But this stock it's not trading at 1,000 times earnings. It's trading at 27 times earnings. Right? I mean, let's say they had a lull, right?
And that's with no China market.
Well, it comes and it goes, so I don't know what's in those forward numbers. I think it just came again, that they're allowed to sell the H100s, but
well, the CEO says he's assuming no China numbers.
I think even if you assume no China numbers, they're going to have they're expecting to have $500 billion in sales in 26. $500 billion in sales. When I repeat that number, sometimes I think I must have misheard it, right? They must have meant something different, but that's an incredible number. And let's say the hyperscalers cut back. Let's say they cut back by 50%. Let's say they, what would you expect NVIDIA to do?
Go down.
Well, what I would expect to happen is their revenue would probably be cut by 50%, at least temporarily. But that's not unheard of for a company like NVIDIA. You should expect that. If you own NVIDIA and you don't think it can go down by 50% in any given 12-month period, you should not own it, or you should own a whole lot less of it, because
that's a good point. You didn't mind the ride up. The ride up is sometimes the ride down to get to where you're going.
Nobody's forcing you to own it. And it happened recently. Let's see, it happened in April this year. It went down 50%, right? You could have bought that stock for $85 a share, I believe, at some point this year. So could that happen again? It absolutely could. Absolutely could. In fact, I would expect it to happen at some point in the future. I don't even think it would take that much. So, I think you at that point, you're going to be betting on two things, right? Your new normal would probably be lower, right? You probably wouldn't expect growth at 30 to 50%. Maybe you expect growth at 20 to 30% from a new base. And you got to reevaluate how much you're willing to pay. But if you have a company that's 27 times earnings and it drops by half and it goes to 15 times earnings and it's still growing at 20% from a pretty high base, well, it might still be a good value, and you might want to step in and buy. I think you just got to reevaluate it when it happens, and if it's keeping you up at night, you won't just own too much of it.
Just for our compliance department, we'll mention that the mention of specific stocks is not a recommendation or offer. Individual investors should do their own due diligence to determine appropriateness for their circumstances and consult your advisor, or if you need help, reach out to a firm like ours.
It's worth mentioning that I own NVIDIA. I own less than an S&P 500 weight of it. We own it in client discretionary portfolios. We own less than an S&P 500 weight of it. So I think that's
also ask Brian, would you, for our listeners who may not know what you're referring to when you use the term hyperscalers, that may not be something that every listener has heard that term before.
Sure. So hyperscalers are, it's a new term. There's no reason why anybody should know it. It's the companies that are scaling data infrastructure, whether it be for the cloud or for AI. So they're, conventionally thought of as Amazon, Meta, Microsoft, Alphabet, and Oracle. They're spending hundreds of billions of dollars. The expected spend that NVIDIA said in 26 is $600 billion from those companies.
Wow. So
right. Yeah. Right. Wow, that's right. And that actually gets back to the private credit conversation, because how are they financing these data centers? Well, there's now many billions, I don't know how much, that is partly being financed by, at least in Meta's case, and I believe in Oracle's case, from Blue Owl, which is a BDC, or you can just call it a private credit, private equity company that trades publicly. So, that business is scaling in whole new places now, and they just backed out of the deal for Oracle, which is why the stock was down pretty significantly on December 17th.
You've kind of addressed this question, I think, of the bubble, I think pretty effectively. And I hear from, as I said, there were a bunch of articles in recent, as this time of year, as people think about forecasting ahead, and the idea that there may be a perception that some of the economic where the benefit in the markets may come from may be expanding beyond strictly these core companies that have been so strong this year. Do you share that perspective, and does that influence your thoughts about capitalization or where you want to invest?
I think there's a lot that is said about how there's, quote unquote, 7 companies, the Magnificent Seven, that drive all the market performance. I just think that's wrong. I just think people aren't working that hard. We mentioned emerging markets earlier and how great of a year they've had. We talked about gold earlier and how great of a year that's had.
Utilities.
Utilities have done well. Other companies that aren't conventionally in, they might be part of the AI trade, but not in the Mag 7, like Broadcom, or, we own Uber and Reddit, and they've done well this year, very, very well this year. And then there's companies like TJX and AutoZone,
Right.
which, nobody talks about, but they're fantastic year after year after year. I mean, they outperform the S&P 500 on a 20-year basis by many percentage points. And unsurprisingly, they had yet another good 25. And these are all companies that we own. The semiconductor equipment companies have done great, right? KLA Corp, Lam Research. I'm sure Applied Materials did well. We don't own that one anymore, but I'm sure it did do well. There's thousands of stocks in the market, right? There's 5,000 stocks in the domestic market. You got to work a little harder if you're thinking that there's only 7 stocks that.
There you go. Hey, I would also, just as we wrap up, you talked a little bit about fixed income, and I think a lot of times people think of fixed income as the part of their portfolio that doesn't perform. They tend to they say, I don't get it, I don't understand bonds, whatever. But fixed income's been doing just fine this year. We've had some bad years in, 2022 was certainly a rough year. But you want to talk just briefly about, as you think about this and some of the decisions you've made as it relates to our positioning in the bond portfolio have been good decisions that it's like, as we're reviewing what happened, it's worth thinking about this notion of duration and where we want to be and some of the things that you've made some decisions around.
It's a good point. I think you own fixed income for stability, and you want to be in it if it's in a, if you're going to get a fair return for the price. And what do I think is a fair return? Are you getting a real return? Are you getting a reasonable real return? And that wasn't the case for a long time, but it's been the case for a few years now, since 2022. And I think a lot of people might have been scared away from fixed income because of the experience of 2022, where it did really poorly. I think the aggregate bond index was down 16%. But these are contractual obligations to pay you money, unlike a stock, which has no contractual obligation to give you anything. A fixed income instrument has a contractual obligation to pay you. So if the price goes down, you can almost lock in, as long as you're a long-term investor, the expectation of better future returns. Of course, there can be defaults. That is really mostly only an issue in the riskiest parts of the market, private credit. So the aggregate bond index, which is made up of primarily investment grade, there is some high yield in there, through December 17th did over 7% so far year to date. A money market fund did almost 4%. So that's pretty good return. I mean, I know it's not stock-like returns, but it's not stock-like risk at all either. So we had a good 26. Now, can you expect that going forward? Well, that's hard to say, right? Because the reason why fixed income did so well is because yields came down, or longer term yields. That's why the aggregate bond index. So the exact opposite of 22, you're fundamentally in a worse shape today than you were 12 months ago. That doesn't mean it's a bad deal.
Yeah.
If you're getting 4.2% on a treasury bond and you add a 1.3% spread to that, you can get a 5.5% bond, investment grade bond. Not too bad. Inflation today, supposedly is at 2.7. Let's just round up to 3%. You're getting more than 2% real yield. If you're a retiree, you're staying ahead of inflation and getting a little bit more. And that's the conservative part of your portfolio, right? Compared to stocks. So, it's going to continue to be a good part of our portfolio. I'm very happy with the positions that we have, and I don't expect to make any changes, except for playing with the duration. If you expect inflation to be higher and not to be any Fed cuts, well then, without thinking about anything else, then I probably want to take less duration. If you think the employment market's going to get worse and inflation's going to come down, because those things are related, then I'd want more duration and I'd want less credit risk. So these are things that are worth monitoring and thinking about every day. But like we said on a different podcast, you approach this with a lot of humility. Don't go all in and all out on anything. And I think that applies to the fixed income market as well.
Excellent. Thanks so much. Great review. Lots covered and lots to think about as we move toward a new year. And if you need a little bit of help in that regard, this is a great time of year to do a comprehensive review of your portfolio, your financial plan, and how things forecast for you. We're going to talk more about that in our next episode. So join us then. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.